All right, perfect. We're recording. But I was sitting in the same shoes as many of you guys not that long ago. So we here at Four Oaks, we came together about 18 months ago. We bought our first property. We closed on our first property at the end of October of last year. And in the last 12 months, we've acquired 7 additional properties, just shy of 500 units, right around $21 million in properties, and raised right at $10 million in capital. So we've been busy in the past 12 months. This specific deal is one of my favorites. It's near and dear to my heart just because of the way it kind of came about. I told Justin earlier today, I get very passionate about this stuff and I start talking and I get going like a freight train. So please ask a ton of questions. Feel free to interrupt at any point. I'm going to go through this. I've never gone through this deal in this type of capacity. So feel free to ask a ton of questions and I'll just kind of start giving you the backstory here and we'll go from there.
Eric, just so you know, I asked everybody to type some questions in the chat so I can kind of pepper you with them as they come in. But guys, feel free to just type your questions in the chat and we'll also leave some time at the end of the call too, if you'd rather just ask it that way.
Yeah, absolutely. So this is about WINDWOOD Garden Apartments. It's located in a little town called Pickens, South Carolina, which is part of the Greenville, South Carolina MSA. For those of you that aren't familiar with Greenville, it's the second largest city in South Carolina. It's in the upstate of South Carolina. So the Greenville MSA is comprised of Spartanburg, Greenville, Clemson, Anderson, and all these little subsidiary markets, of which Pickens is one. Pickens is about 17 miles from downtown Greenville. So it is in a really strong location where folks can commute to the kind of the Greenville market. One of the things we loved about Greenville was it's known as an inland port. And if you're not familiar with an inland port, which I was not at the time, all these coastal port cities, you've got Jacksonville, Savannah, Charleston, Wilmington, all the way up into Virginia. And these massive cargo ships come over and they bring all of these goods. Well, it's extremely expensive. It's extremely expensive for companies to have manufacturing facilities and warehousing facilities in coastal markets. So what they'll do is they'll unload the cargo containers and then they will bring them inland on trains and on 18-wheelers to in these inland port markets. And these inland port markets are inland ports because they're surrounded by interstates. So in Greenville, for example, there's 4 major interstates that run basically through Greenville. It's 2 hours from Charlotte. It's 2.5 hours from Atlanta. It's an hour and a half from Columbia, South Carolina. So it's right in, and it's only like 3.5 hours from Raleigh, North Carolina. So it's right in the mix of all of these major kind of transportation hubs. And there's a ton of manufacturing. There's a ton of industry. BMW, every single SUV made by BMW is made in Greenville, South Carolina. So there's a ton of reasons that we really like the Greenville market. We actually own 6 properties in the Greenville market right now, and WINDWOOD was our 3rd. So this deal was introduced to me kind of directly from the owner of the property, a broker friend of ours who we had bought our first 2 assets from in the upstate, said there's a guy named Jason Dillard. You've got to meet him. He's a great guy. He's super interesting. He thinks outside the box. He's very creative. You should meet this guy. You should talk to him. So I was in town. I reached out to Jason and wanted to see if he wanted to grab a cup of coffee, and he obliged. And we sat down and we started talking. And we had about a 3-hour conversation where I got to know this guy kind of in depth. And Jason was not a multifamily guy. He was primarily single family. He owned a fix and flip company. They did anywhere between 80 and 150 fix and flips a year in the upstate. And then one thing that was really interesting about Jason was he was one of these guys, he was a barterer. And there used to be a show about this on like A&E or one of those types of channels. But he's the guy that would start with a safety pin and would trade into a pack of Post-its. The next thing you know, he has a 67 Mustang. You're like, how in the hell did this guy get a car from this? But he just would trade back and forth and was involved heavily in these communities. And that's how he acquired this property, was he did some trading and ended up trading a couple single families and a couple other things for this property. And at the time, he bought this in 2016, I believe, 2016 or 2017. And it was just not there was a lot of deferred maintenance. It was not being managed well. And he came in and he thought he had all the answers. Again, he was a single family guy, and he just didn't see how this could be that different. But once he had, I'm going to mute you, Salvador. No, it's not letting me. There we go. But once he actually got into the property and started really learning a little bit more about multifamily, he realized that he didn't have all the answers. So he spent about $300,000 renovating a bunch of the existing units, kind of doing some stuff to the exteriors. And what's interesting is he didn't really fully understand NOI and cap rates and the relationships there. So he was putting the money into the property, trying to fix it up, and he was trying to self-manage and realized that wasn't a strong strategy for him. So we ended up bringing in a property management company called SDMC, who is actually our current property management company for multiple assets now. We really like those guys. SDMC was able to right the ship. But like all management companies, they ultimately defer to the wishes of the owner. And so of the 80 units, Jason wanted to take 8 of them and convert them into storage. So 4 of the units were completely down. They were gutted to the studs already. And then there were 4 other units that needed some pretty heavy renovations as well. And he decided to take them down to the studs as well and put up chain link fence and create within these 8 down units, create storage compartments. So each unit could hold roughly 8 to 10 kind of 8 by 8 foot type storage lockers, if you will. And he was going to rent those out. And that was his great idea. So when Jason and I got to talking, I saw immediate opportunity because of first and foremost, the purchase price. I knew he wanted around $2.5 million, which worked out to around $30,000 a door. And then with the 8 down units, I saw a tremendous amount of upside to come in and, fix those units up, bring them back online, and add some tremendous NOI to the property right out of the gate. So Jason and I got to talking. He was interested in selling, but didn't really know what it was worth. Knew he wanted around $2.5 million. But he knew he wanted to do a 1031 exchange. And he didn't have anything picked out. He hadn't even been looking. But we said, all right, well, what if we did a master lease option? And if you're not familiar with the master lease option, it's kind of a way where we would come in and we would lease all 80 units from Jason for a set price. And with that set price, we would then in turn be allowed to sublet those units out to other people. And what Jason was going to allow us to do was, even though we were leasing the product from him, we would have an agreed upon price point. So we would say, all right, for the next 18 months, we're going to agree to lease the property from you for, let's say, $20,000 a month, right? And that would essentially be our mortgage payment. And we would lease that property, and that would give him time to find a 1031 property to roll into with no pressure, but we would agree to lock in the price today. So regardless of what happens over the next 18 months, whether the economy goes up or down, we have the right to exercise our option and buy the property from him for the originally agreed upon price. Well, this was a great model from us, being kind of new to the game, because we didn't have a ton of money. So this allowed us to get in without, any major down payment or kind of anything crazy out of the gate. We knew we were taking over a cash flowing property with a ton of upside. And it was a really creative way to come in without a lot of money in our pocket. There was a ton of upside with this property, which we'll go through in the underwriting in just a minute. But before I get too far into it, I'll show you a little bit about the deal and kind of what we ended up doing here. It's 80 units. We ended up getting it under contract for $2.41 million. We realized we needed to put about a $1.25 million into the property. It was going to be a 6-year hold. We knew eventually we were going to buy it, whether it was through the master lease or through conventional financing. We knew eventually we were going to put a mortgage on it. And so this was kind of the returns that we were looking at. It was going to be a 9% cash on cash, 14% IRR, 16.5% average annual return, and in a super conservative resale of 7.5 cap. So the Greenville market C-class assets are currently trading in the low fives as far as cap rate. So we knew that if we exited somewhere in the sevens, that was extremely conservative. Keep in mind, again, this was our fourth deal ever. So we were still building a track record. So we really wanted to make sure that we had hyper conservative underwriting to be able to present to our investor base so that we wouldn't have any issues raising capital.
Eric, can I ask a question?
Yeah, please.
It said total raise as 1.25 million, and you said total renovation as 1.25.
I'm sorry. Yeah, total raise is 1.25. I'll go through the CapEx budget in a minute. Yep. So the total raise on this was 1.25. Good catch. I apologize.
Got it. No problem.
So yeah, the CapEx budget you'll see was just over $500,000. So the unit mix of this is a unique property because of the way it was laid out. So there's 80 units. 60 of the units are traditional garden style apartments. The other 20 are 10 duplexes that are kind of right next to the garden style apartments. And you can see it. We'll look at an aerial view in just a minute. So there turned out to be 40 one-bedroom, one-bath units. 20 of those were from the duplexes, and 20 of those were the garden style apartments. 39 two-bedroom, one-bath units, and there was this one three-bedroom, one-bath unit. That unit was a two-bedroom, one-bath that the original owner way back in the 70s lived in and needed extra room, so added on an additional bedroom. And that's why there's just one three-bedroom unit. As I mentioned earlier, there were multiple down units that we were able, that we saw the upside of being able to convert. He had already he had already renovated about 50% of the units that he had. And he spent, to be quite frank, he spent way too much money renovating these. Again, single family guy, came from a residential background, and he really put a lot of money. He spent about $13,000 to $14,000 a unit, which was just too much for what he was going to be able to get for the rents. And we'll go through that in just a minute. One of the other things we really liked about this property was the amount of green space. There was a ton of green space and very little amenitization. So we saw an opportunity, while we were going to improve the interiors and exteriors of the buildings, to also add amenities, which was going to create additional value for the property. Current rents were averaging just over $500 a month, and that included the water. We saw that we could increase the rent significantly over the first 3 years and still be very competitive in the marketplace, and also bill back for both the water, the sewer, the pest control, and the trash, which was going to allow us to generate about, on average, around $40 a month through our RUBS. The property appraised, so he did a refi right before we took over the property, and the property appraised for $2.7 million, and we had it under contract for $2.4 million. So we originally, when we first put this deal, we submitted the LOI with the master lease option. It was at this $2.4 million, and he came to us about, 2 months into the LOI. Well, we had it under LOI, we put it under contract, and during our due diligence period, he came to us and said, "Hey, I've already identified a property to 1031 into. Would you be willing to sell it conventionally?" So we originally had it under contract for $2.6 million. And we said, "Yeah, absolutely. We would entertain that. What would that look like?" And he said, "Well, what if I knocked 10% off the purchase price, which was roughly $200,000, and that got us to the $2.4 million." So we said, "Wow, that would be amazing. We could come in, we could assume this new mortgage," because we knew that he was in the process of refining. So we could assume this new note. We could take advantage of the interest only period. We could get some significant equity right out of the gate, and we could kind of pick up where he left off with all this momentum. And for those of you that are actively looking for properties, it's unheard of to find a property for $30,000 a door. I never want to use the word impossible, but it's virtually impossible to fail when you buy that cheap. So we saw a tremendous amount of upside in this property. So as I mentioned, he had put around $300,000 of renovations into the property. He put in black appliances, faux granite countertops, new cabinet fronts, and then LVP. And they really look nice. And I'll show you guys some pictures in just a minute. So we knew we could take what was currently a C class asset and bump it up into a C plus asset. So you can see a $2.4 million purchase price, a $1.25 million capital raise, a 6-year hold on projection, and we'll talk about that in a minute as well. And then these are the returns that we had looked at based on our conservative underwriting. And this is kind of what we were looking to do. So in the first year, we knew that we wanted to keep rents kind of flat. That would give us time to really let the property management company, they had just taken over about 8 months prior to us getting involved. And it would let them continue to kind of execute on the strategy, get the right tenant base in. And then we would gradually improve the occupancy and bump rents over the first 3 years. What we didn't know, and we'll touch a little bit on current performance in a little more depth in a few minutes, but our property management company has knocked it out of the park. We are on pace to hit our year 3 projections in our first 12 months, which is going to allow us to exit significantly sooner than our originally anticipated 6-year hold. We'll go through underwriting in a little more depth in just a minute. This was a 75-25 split. So 75% to the LPs with 25% going to the GPs. And then on the back end, we have a hurdle built in. So once we hit a certain hurdle, the GP side gets significantly more ownership on the back end. We'll touch on that when we get into the underwriting. So this is the property from above. So you can see these are the 60 kind of standard units. And then these are the 10 duplexes over here. But there's a ton of unused green space to add amenities. What we've done is we actually added a playground up here, as well as a grilling space, another grilling space over here. And that's all we've done for right now, but we have some additional amenities such as a dog park and things like that that we're going to be adding in the future. But just look at how much green space there is. It's really nice when you have this kind of sprawling layout to be able to implement some amenitization. This is Pickens from above. You can see this is the apartment complex right here. And then this is downtown Pickens, just a couple miles away.
Eric, question for you.
Yeah.
With SDMC, the property manager, had you worked with them before? This is the first time.
No, so we'd interviewed them prior, and we just didn't have a good fit for them. Our first 2 acquisitions were in Spartanburg, and that was more of a B plus product. And SDMC is known for being kind of excelling in the C-class space and that C-class tenant demographic. That's what they were known for. So we didn't have anything at the time. And then our third property that we bought ourselves, and it was more of a Section 8 play. Again, it was one that we just bought super cheap. We bought it for just over $20,000 a door. And we knew that we were going to be able to put it into the RAD program, which is a very favorable government subsidized program. And so this was the first property that we came across that was the right fit for them. And then after seeing what they had done in the 8 months kind of prior to us taking over, it had been very, very impressive. And so we decided that we wanted to keep them on board and give them a shot. They were already doing good things. They saw our strategy, and we had asked for an independent pro forma prior to showing them kind of our business strategy. And they came in actually significantly higher with their 3-year strategy than what ours was. We said, well, that's great. If they can achieve what they said they can achieve, we're going to knock the cover off the ball. If they fail or they're going to fail to our numbers, that's a pretty darn good place to fail to. So we decided just to kind of stick with them for that reason. Since then, we've fallen in love with those guys. We've used them for our last 4 acquisitions.
Thank you.
Yep, absolutely. So in the Southeast, mansard roofing is pretty common. Gosh, we've picked up 5 of our 8 properties have mansard roofing. So that's what you see here. If you're not familiar with it, I know it's super popular in the Southeast. I don't know how popular it is when you get outside of that. You guys don't have a ton of that in Minneapolis, do you, Justin?
We actually do see, I wouldn't say a ton of it, but I feel it looks pretty familiar in like St. Paul properties.
Yeah, it was a big, it's like you look at the 70s and you saw mansard roofing, and then you get into the 80s and you saw like the Bostic boxes, and it was just like you see these trends. but it was 80 units on over 8 acres. So, I mean, that's just a huge amount of green space, 14 buildings, but of those 14 buildings, that included the duplex buildings. Laundry facility on site, like I said, a ton of green space. These were the amenities that we're looking at adding, and we've done kind of 75% of that currently. And then the dog park, we're on the fence with the dog park. We don't currently allow pets. And we're trying to decide if that's the right path to go down. And so we're on the fence with the dog park right now. I don't think that's going to be something that we need to do, but the playground was imperative. We knew that putting a playground in would really allow us to focus on kind of that family dynamic. And since we spent about $30,000 putting a playground in and fencing it in and doing the nice playground mulch. We got a phenomenal deal on a playground. It was about a $40,000 playground that someone had put a down payment on, and they ended up not fulfilling their order. And so they offered it to us for $25,000. And so we jumped all over that. And since then, the phone has rang off the hook with families that have heard that, we're putting all this money into the property. So it's really been a huge thing for us by adding that playground as an amenity.
Eric, is it your policy to not have pets at your properties, or was this something particular about this apartment?
Yeah. So here's the problem with pets. There's good and there's bad. The good is that you can collect pet rent. So that's additional NOI. The bad is that what you make in NOI, you spend in turn costs. So pets are going, for the most part, pets put tremendous wear and tear on the apartment. So if there's an apartment that already has pets, we will oftentimes keep that. If they do not yet have pets, we will oftentimes keep that. Mm-hmm. So and our property management company has said that when you allow pets, then people get greedy and they start trying to sneak extra pets in, or they try to flirt with the weight limit or the breed limits. And it also opens you up to potential litigation as far as if a pet bites someone. And so there's upside and there's downside there. It's really about, for us, it's about what the property is currently doing at the time of takeover.
And with any of this stuff, the grilling or the playground, any insurance concerns as far as cost of insurance that affect things much?
Yep. So we let our insurance provider know that within kind of right out of the gate that we were going to be adding these grilling spaces and playground. So we went ahead and had them quote the insurance with those amenities included, just because we were going to be adding them within the first 8 weeks of takeover.
Obviously, it wasn't like too cost prohibitive to do it.
I honestly don't know what the difference was, but it certainly wasn't cost prohibitive to do it. Right. The upside far outweighed any kind of. The other thing is, insurance is a really interesting thing, and especially right now because insurance is going up like crazy. So in markets where insurance used to be $350, like Memphis is a great example. We were just looking at a property in Memphis with Drew. And it was a big property, but they were estimating insurance to be around $450 a door. And the reason it was so high was because Memphis just got hammered by tornadoes last year. And so because of that and some of the other things that had gone on in other areas of Memphis, Memphis was kind of deemed a higher risk market, and that caused insurance to go up. So in Greenville, Travelers certain insurance companies will buy a market. So if an insurance company deems a market to be really attractive, they will buy that market. And what that means is they'll offer super, super competitive or really ridiculous rates to be able to earn the majority of that insurance business in that market. Well, as I mentioned earlier, we have, of our 8 assets, 6 of them are in the upstate, which is this Greenville MSA. And so we were able to get a policy with Travelers, which is one of the top insurance providers. It's a double diamond, or they throw out all kinds of fancy ratings, but it's one of the top, Travelers nationwide. It's one of the very well-respected multifamily insurance providers. We were able to get insurance on this property for $180 a door, which is crazy. I mean, that's unheard of. And since then, we've been doing endorsements on that original Travelers policy, And all of our insurance in the upstate is under $200 a door, which is crazy. So we've been very fortunate with that travelers policy because travelers really wanted to earn our business and wanted us, they knew that we were heavily focused in that Greenville market. So they gave us super competitive rates. So if we look at kind of a before and after, I know this is kind of faded out, but you can see just flat wood cabinetry or faces, the old kind of dated linoleum floors, white appliances, this faux butcher block countertop. And then when we did the renovation, this is actually one that was a model, but the black appliances, faux granite countertops, shaker doors, updated hardware, LVP flooring, and it just really pops. It puts us kind of at the upper echelon of this market, and it's allowed us to really command some rent premiums right out of the gate that we would not have been able to get otherwise. One of the other things that we're doing that's unique is SDMC does not have a construction arm per se, but we're able to leverage. So we brought in specific additional maintenance folks to help with upgrading units. So instead of outsourcing, we are able to do it in-house for significant reduction in price. So the only things that we outsource are flooring and painting. And those two things are just cost effective to do outsourcing. Everything else we're doing in-house. And we can certainly touch on kind of the product lines that we're using. But as long as the boxes are in good shape, we use Cinch Kit, CINCH kit for the doors. So we're able to do all of these for about $800 for the cabinets, plus labor. The countertops are costing us around $300. The LVP, we're having the LVP and the installation combined, we're doing for about $2 a square foot. So we're getting really competitive pricing. So we're able to renovate these entire unrenovated units. We're able to upgrade for about $3,000 to $3,500, depending on the appliances. If we add in appliances, it's closer to $5,000. Without appliances, it's right around $3,500, which is phenomenal. That we're able to get the rent bumps that we're getting for those price points.
That is a rehab unit that we're looking at there.
Yep, this is a renovated unit.
That question, well, obviously it's a good looking unit, but I was just curious about the appliances. Are you going black appliances?
Yeah, for C-Class, we stick with black appliances. The amount of money we would be able to get for stainless is just not there. We won't do stainless unless we're doing solid surface countertops. That package just kind of goes in conjunction with one another. So here's kind of a breakdown of our CapEx. So landscaping, we knew that we wanted to put in some nice landscaping, make the property pop. Our landscaping was so we took over this property in mid-June. Our landscaping just was completed this past week, the week before Thanksgiving. It looks amazing. They've done a great job. The $68,000 pressure washing, that was to pressure wash all the brick, replace any rotten wood and paint. We actually got the quote finally came back on that, and they started work on that last week as well, the week before Thanksgiving. They're doing all of that for $30,000. So we're well below budget on that. Roofing, we just had a couple areas that needed here. Listen, you know how to mute. Oh.
Yeah, hold on. I'm gonna try. Eric, I might have to have you give me
Screen share back.
Yeah. But it looks like we did it.
Oh, did I do it?
Yeah.
Sweet. Roofing, we just had a couple little patch areas that we needed some patchwork on, primarily on where that mansard, the asphalt shingles on the downslope had come loose. So you see asphalt patching, that's for the parking lot. Concrete, there's some areas of the concrete where over time the concrete's just buckled with root systems coming underneath. So that's for sidewalk repair. Seal coating the parking lot after we patch it. It brings the exterior renovation total to 162. And then there were 33 unrenovated units that we had a $5,000 budget for. That came out to $165,000. And then those 8 down units, we had a $200,000 budget, but we actually ended up getting quotes that came in right around 148,000. That left another $50,000 to be able to kind of add to our excess. Our excess. I don't know how to mute, Justin.
Esther, if you're listening, we got to have you mute. While she's muting, hopefully I can't, for some reason I can't mute her, but quick question for you on due diligence. So when you did all this, were you assuming that you were going to be under master lease when you're doing due diligence, or did it really not matter because no matter what, you knew you're going to buy the property eventually?
Yeah.
You know what I mean?
So the strategy changed because when we originally had it under the master lease option, Jason was not going to allow us, the owner was not going to allow us to bring in our own, like to do our own, we weren't going to be able to renovate units, like put our own money in until we took it over. So I guess our strategy somewhat shifted because of the time frame in which we're going to be able to renovate units. Does that make sense?
Yeah.
So we thought originally for the first 18 months that we were not going to be able to renovate units. So we were going to just have to rely on because what we didn't want to do is renovate the units. And then if for whatever reason he pulled out, now we had put all this money into the property that we didn't get to see the upside on, you know? So our strategy changed significantly once we realized that we were going to be able to take over the property as far as timing. But the budget did not change.
Go drink.
Hey, Esther, if you can hear me, can you mute, please? Esther?
Justin, let's see if it'll let me mute all. Mute.
There, she's muted now.
All right, perfect. Did that answer your question?
Yes, thank you.
And then when he did the refi, if you guys have gotten agency debt before, the lender will send someone out to look at the property and they will say certain things have to be done. So like in this case, the sidewalk, that concrete damage that I was talking about, that was a tripping hazard. So that needed to be fixed. Then there were some outlets that needed to be kind of switched over to GFI outlets instead of traditional outlets. And so there was a $35,000 escrow account that we actually took over when we closed the property, that Jason had to put that money in escrow, and then it was transferred over to us at closing. So that took our $527,000 CapEx budget down to $491. Does that make sense?
Yep.
So the one bedroom duplexes, they were at $433. The goal was to push those to $500 in 3 years. Remember, there's 20 duplexes. In the last 3 weeks, we've gotten 3 of those duplexes leased out at $550. So we're already exceeding our 3-year rent projection by $50 with 3 of those units today. We've only owned the property for 5 months. All of our new leases are getting $700 plus $45 in rubs for the 2 bedrooms and $600 plus the $35 in rubs for the 1 bedrooms. So of the 80 units, we have about 20 roughly already that are getting our 3-year rent projections within the first 5 months. And then we're gradually pushing the existing leases. For renovated units on the turns, we're pushing already straight to the 700 for the 2s and the 600 for the 1s. On the units that haven't been renovated, we're pushing to 575 for the 1s and 650 for the 2s on renewal. So we're getting really nice chunks in renewals, and then we're getting market rent today on turns for new leases, which is pretty awesome. That's going to allow us to exit this property in 3 to 4 years instead of the original 6-year hold. And I'll show you guys what that'll do to the returns in just a minute. It's pretty astronomical. This is just kind of an overview on Greenville and why we like Greenville. I don't want to bore you guys with kind of the details of the market. But Greenville is a super solid market. It's been voted all these accolades. So Greenville's on fire right now. Pickens just outside of Greenville. So you can see our 1-bedroom comps were 615 and 715 respectively, and at 812. we were trying to, and that's today, we were trying to push rents to 600, 700, and 800 in 3 years. So we knew that we were being pretty conservative, trying to be below what rents are today in 3 years.
Nate was wondering about physical and economic occupancy now.
Yes. So currently the occupancy is a little skewed because we still have down units and we're factoring that. When we took over the property, it was at 15% vacancy, and that did not include the down units. We're now at 13% vacancy, including the down units. Of the 8 down units, 4 of them have been renovated and are inhabited. One of them has a move-in next week. So that'll be the 5th one. And then we'll have 3 additional down units after that.
Those
and then we do have, of the 80 units, we do have a unit that we donate to the police force. There's a police officer that lives there. He lives there for free. But having him on site just adds tremendous peace of mind to the tenant base. He keeps his cop car parked in the parking lot. So any disputes, if there's ever any issues, they're handled on site and we'd never get a phone call.
Hey, Eric, just to piggyback off that, do you notice any trends, like since you've done a handful of acquisitions now, in terms of vacancy when you first take over in the first few months compared to maybe, the middle part of the year and then towards the end of the year?
Yeah. So when you first take over a property, you're going to see or at least we do. We see a pretty significant uptick in vacancy. And that's for 2 reasons. One, it's new management. And when I say new management, even though we're keeping the management company in place, it's a new business strategy. So we're coming in and our goal is to get the right tenants in and get them in quickly. So if we have any, what we call deadbeat tenants, we move to evict immediately. So we don't mind a higher level of vacancy right out of the gate. And we underwrite for that specifically. And Steve and Justin, I know I've seen, they're partnered with us on an Augusta deal that we're working on. And so we just closed the deal 2 weeks ago. That was in Clemson. That's right down the street. Justin's actually invested in that one passively. We built in 22% vacancy in year 1 for that deal. We built in 25% vacancy year 1 for our Augusta deal. Do we think that we're actually going to see that level of vacancy? Absolutely not. But we're at the tail end of a market cycle as far as just looking at the economic recovery. The last recession was 2008 through 2010. So we're at the tail end of a market cycle. We're in the midst of a global pandemic. We're in an election year where this is not meant as a political statement in any way, shape, or form, but there's a lot of concern as to what the Biden tax plan will do. There was no question that Trump was pro real estate. His son-in-law Kushner runs one of the largest apartment companies in the US. So there were a lot of things under that Trump presidency that were passed that were very favorable for apartment owners. Again, not a political statement, just a factual statement about taxation. So there's a lot of concerns as to what a changing of the guard will do to the apartment market. And then there's a CDC eviction moratorium in place right now. So it's super important to be conservative in your underwriting in that first year in particular. We normally see, so if you think about what does 15% vacancy mean, right, Steve? That doesn't mean that you have to have 15% this month or next month. It means over the course of 12 months, you're averaging 15%. Well, what does that mean when you're looking at an 80 unit building? That means you have to have 12 vacant units for 12 consecutive months. So we knew that was not going to be a problem. We knew that there was demand for quality product at a reasonable price point. And we knew that if we put the money in, there was demand at that new market rent because it was a higher level of product. So knowing the market well allowed us to come in and feel really confident with that 15% vacancy rate. So we spiked early on. We're below that 15% vacancy rate now. And then we're closing that. We have 4 units pre-leased that'll move in December, which will close the gap to 93, 94% here by the new year.
Just to piggyback off that too. I mean, in the Michael Blanc program, we're taught that 10% is kind of the rule of thumb.
It's knowing your market, right?
Yep.
So the Greenville market is around a 5% vacancy market. So we knew again at once we're stabilized, we have in years 4, 5, and 6, we were looking at a 10% vacancy rate, which is extremely conservative when you're in a market that's showing 5% vacancy.
I got a few for you, Eric, just to catch you up on
Yes.
some of these questions. So the rent comps, are the utilities included, or was it standard for RUBS in the market?
So utilities, it was individually metered for power. And then water, sewer, trash, and pest were not included. Greenville, so Greenville proper, RUBS are very common. Pickens, there's only 4 market rate properties in Pickens. We now own 2 of the 4, which is nice. So we can dictate, the other 2 market rate properties are significantly smaller than this. So we own about 70% of the market rate properties in Pickens, which allows us to kind of dictate what that market does. And then we're still significantly below the rents in Greenville. So it gives us, a couple things to touch on. We're still below the rents in Greenville. And then one of the things that we look at that we think is a great indicator of the strength of a market is the gap between the cost of monthly home ownership and the cost of renting. So in Pickens, that gap per month is around $365 a month, which is a pretty significant gap. So if you can't afford home ownership because of the price of home ownership, we knew that we had a pretty robust window to fall into where we could still be a viable option and have a really nice product, but still push the upper echelon of the rent premiums and still stay well below that home ownership rate. Does that
What's a
make
great
sense?
source to get that data from?
So we got it through a variety of different places. Really, if you look, I knew what from my residential portfolio, I knew what the cost of home ownership was. But you can get it by looking at like Zillow or any of those places. You can see what the average mortgage price is. You can also get it from the census website as well.
And then were you able to get agency financing with the 15% vacancy? Was that an issue at all?
So it was a loan assumption. So that's another. So when it went from, so this is where it gets kind of hairy with this deal. So we had it under contract for a master lease agreement. And he said, you know what, interest rates are so good. You have it master lease. Our contract term was 18 months for the master lease portion. And he was like, I'm going to pull out some equity and reduce my interest rate. So he was going to do a refi, which we knew. And we decided once we saw the rate that he had gotten at the time, it was good. You guys are going to look at it now and say, why would you ever do a 4.7% interest rate? But at the time that was good, believe it or not. That's one of those, like, I used to walk to school uphill both ways, naked in the snow, but 4.7 was very attractive at the time. So we knew that we were going to be taking over favorable loan terms, and with the master lease. So when we went to buy, it was a loan assumption. We had already done 2 deals prior that had agency debt, so we felt confident that we would be able to assume that with our background, and that once we went through that assumption process, which was a nightmare. It took 6.5 months from the moment we put the deal under contract till the moment we closed because of COVID and the loan assumption process. Fortunately, Jason was extremely patient. But not only were we able to assume the loan, we didn't have to pay any of the reserves that come with new agency debt, which was a huge win. And then it also helped build our book of business because now we have a 167 unit in Augusta. That's a $7 million deal that we're assuming because we went through a loan assumption with CBRE once. It gave us the experience that we were able to do that without bringing anyone on board. So it's really helped boost our own book of business and made us much more attractive to the lenders.
And then Joy had a question about identifying a deadbeat tenant right away. Does it take time, or can you do it? How do you identify it right away?
Yeah, so there's a couple of things that we look for. We look at delinquency reports. That's the number one, and see who's been paying their rent on time or who's consistently paying late, who's accruing, late fees regularly. When we do lease audits, we're looking at employment. for whatever reason, every owner has their own criteria as to who they'll let live in their apartment complex. And so if there were people that did not meet our criteria, those were people that were kind of red flagged right out of the gate as possible. Deadbeat's not a nice word. I probably shouldn't have used that, but not optimal tenants is probably the nicer way to put that. So those are some things that we look for. But no, first and foremost is delinquency reports, and then really picking the brain of the property management company. We were fortunate enough to keep the current property management company. And so they knew the tenants better than we did. And they could say, oh, Miss Cindy, who lives in unit 62, she pays late every month, but she always pays. Like the money always comes in. She always pays her late fees, so on and so forth. So at that point, then we have to decide what's more important, a tenant that's going to pay even though it's late, or a vacancy right out of the gate unnecessarily. And for us, maintaining collections and having that steady cash flow coming in while we're doing the renovations was pretty important to us. Maintaining high levels of occupancy is paramount.
And then Danielle had a question: how do you manage investors' capital as far as holding funds when you're sitting at a 6-month close?
Yeah, that's a great question, Danielle. Danielle, congratulations. Danielle just closed her first deal a few weeks ago. So congratulations to Danielle. So ideally, had we known it was going to take that long, we would not have. So kind of twofold. Just because the deal was under contract for 6 months doesn't mean that we were holding investor money for 6 months. They had not wired their funds yet. Even once they wired their funds, we still ended up holding their money for almost 10 weeks, which was longer than we anticipated. The good news was, while we kept getting more and more promising information coming in while we were waiting to close, that we were able to communicate at a high level with our investor base and keep them excited by getting quotes that were coming in under budget. The property management company was reducing vacancy as we were moving towards taking it over. So with all of this upside, there really was not a lot of pushback from our investor base. So I really think that, communication and transparency are paramount. Had we held their money much longer, we would have had to pay interest on it. But there's so much upside with this property that it really did not become a major issue with our investor base.
I can speak from kind of being on the investor side of this, Eric, with, Brian Mallon on your team is in charge of investor relations. And, Clemson there's a little bit of hold up at the end there. It wasn't as long as this. And we got an email every Friday from Ryan, and I've stolen that tactic. And that's why we talk about little nuggets, Eric, little things every week that you can touch base with on the investor to let them know, like, hey, this is just something that took place this week. And here's some positive news going on in the marketplace, or whatever it is, just to keep people engaged. Even if it's not a 6-month hold or even a 10-week hold of capital, it's more of like, hey, you've soft committed, but we're trying to get you to the point where we're going to wire, and you want to keep all those people engaged and excited about the project moving forward. So.
And it wasn't just those weekly emails. We'd pick up the phone and call people and share that excitement. And Justin can speak to that as well. And as a result of that, our last 3 deals, not only were we fully funded within 48 hours of our webinar, but we had 100% compliance, meaning 100% of the people that committed ended up wiring their money. And that's unheard of. And I fully believe it's because of our level of communication. We make sure that people are on board and we're answering questions along the way. And there's really not an opportunity for them to second guess kind of their investment.
Well, hey, we're at an hour. So is there a bow that can be put on it? I don't know how much you got through of what you were going to present.
Yeah,
but
sorry.
It was good information. So.
Yeah. So I think sourcing deals is important. Get to know your brokers well. For those of you that are new, provide feedback quickly and provide feedback with really good meat in it. And so when a broker sends you a deal, send them within 24 to 48 hours. So if someone sends me a deal, I immediately respond as soon as I can and say, thank you for sending this to me. I'll have some feedback for you within the next 24 to 48 hours. And then early on, while we were building relationships, we would send back that information with a few snippets of our underwriting saying it doesn't work and here's why. And that really let our brokers see that we knew what we were talking about with our underwriting. So, because most brokers know that the deals that they're peddling are not realistic deals. They're trying to find a sucker that wants to buy a deal at an inflated rate. So they know that the deals that they're peddling aren't good deals. So that helps build credibility. Anytime that you can talk to the seller, talk to the seller. You're always going to get better information if you can get to the seller. The way to get to the seller is build good broker relationships. If they know you're not going to screw them out of the commission, we actually paid the commission on this deal out of pocket, by the way. And we did it because technically we did this, we negotiated everything through the broker, or excuse me, through the seller himself, but the broker put us in touch with the seller to begin with. And so we felt like the right thing to do was to pay a 2% commission out of pocket. It kept the seller happy, or it kept the seller happy because they didn't have to pay a commission. It kept the broker happy because they got paid on a deal that they really didn't have much to do with. And since then, we've closed 5 of our 8 deals have been through this broker. So they feed us. I'll give you a great example. A 28 unit, which is smaller than what we would normally do, but it's literally right down the street from our Clemson deal that Justin's involved in. It's 28 units, townhouse style, 2-bedroom, 1.5 bath, 800 square feet. We got it under contract for $31 a door. And we saw it before anyone else did. The broker brought it to us and said, hey, this is off market. It's going on market tomorrow afternoon. I drove 6 hours down there that day, looked at it, put it under contract on site, literally made an offer on site, and we had it under contract that night. We had it under contract for $31 a door and multiple offers. They had 8 other offers on that deal after us, with the highest offer being $42 a door. So had we not had access to that deal, we would have lost it.
And that was the same broker.
Same broker.
And just for some perspective too, how many deals do you think Four Oaks looks at per week and underwrites per week?
So my team, we underwrite anywhere between 60 and 100 deals a month. So let's call it 100 just for round numbers. So we look at 300 deals a quarter. We submit on average 5 to 6 LOIs a quarter, and we put about 50% of those under contract. So we're putting 2 to 3 deals a quarter under contract.
What, Eric, is a good way if people wanted to reach out to Four Oaks, get on the investor list or whatever? Yeah. What's a good way to get hold of you?
Yes, you can check out our website at www.fouroakscapital.com. That's 4 spelled F-O-U-R. You can email me at Eric Shirley, ERICSHIRLEY at fouroakscapital.com. Or you can feel free to text me or call me at 803-917-6800. I love paying it forward. There's been a ton of folks that have been super generous with their time and knowledge and been hugely instrumental in my growth. And so any way we can pay it forward, we'd love to. I know I saw several names that I've talked to regularly. And I think Steve and Justin can also tell you, we've spent a ton of time, just spitballing and bouncing ideas off those guys. We love Steve and Justin. We look forward to working with them, not only on this Augusta deal, but on multiple opportunities in the future. So
thanks for doing it, man. I appreciate it. We could have done 2 of these. I feel like we had so many questions.
But I feel like I didn't get through much. I feel bad. I feel like there's a lot left to cover, but
we appreciate it, man. Thanks for doing it. Can you make me host? Do you know how to do that? And I don't know if people can stick around. We're going to maybe spend a few minutes doing some breakout rooms or something if people can stick around. I know you got to run, Eric, but
how do I make you host?
I think just go to participants.
Yep.
And then if you see me hover over my name, it should say more.
There we go.
and then just say,
Make host.
no.
All right.
Just to piggyback off that too, I mean, Justin and I love talking multifamily, and we're obviously partnered with Four Oaks as well. So, I mean, if you guys all want to have individual conversations and talk more, we're all happy to do that. We love this stuff. So, thank you all for attending.
Yeah, I'll stick around for a few minutes. If anyone has any other questions, feel free to hit me up in the little group chat or whatever. I don't know how this works next, but
I don't even know if I can do breakout sessions now, but hold on just a second.
I have a question actually.
JB,
Go ahead.
what's-
Don't mind. Hey, Eric, how you doing? So what do you guys do in situations where you're buying something that has basically has 100% occupancy, and you're not going to do a lot of work to it, and the market, vacancy is at 7% or whatever? Would you guys keep it at like 10% so you still have some kind of spread, or?
Yeah, so it's interesting because everyone has their own way of branding themselves and kind of coming to market with. So we have built our brand around conservative underwriting, right? And so when we present to investors, we say, listen, we're looking at a 17% return on investment, but that's with this doom and gloom underwriting. There's so much upside. And the way I spin it with people is I say, listen, I could change these metrics to be still conservative, because if you're in a 7% vacancy market and you say you're at 8% vacancy in your underwriting, you're still below market. You know what I'm saying? So technically you're being conservative, but we wear our conservative underwriting like a badge of honor. So I'll build in a intentionally high conservative, and JB, we've missed out on deals because of it. But at this point, because of those four key things I mentioned earlier, with the end of an economic cycle, COVID, election year, and the CDC moratorium, I would much rather tell you I'm going to give you a 17% return with a ton of meat left on the bone and under promise and over deliver than tell you 20%. And then if I come in at 19%, you should theoretically be happy. 19% is a phenomenal return, but it's not what I told you I was going to do. You know what I'm saying? So it's a really gray area because we've branded ourselves as really taking a lot of pride in our underwriting and how conservative it is and how much upside there is. You're in the WINDWOOD deal, right?
I am. Yeah. I just realized that halfway into it. I was like, oh, I think I invested in that.
So to give you an example, that WINDWOOD deal, it was a 16.5% average annual return on a 6-year hold. If we sell at year 3, the way our projections are now, it's a 29% average annual return.
Okay, cool.
So, but you like the deal at 16.5%.
Yeah.
But when I come in and I give you a 30% return on your investment on an average annual return, you're
pretty
really
happy.
Yeah.
So like when your guys are being conservative, do you try to be like 30% above what the market is, 40?
No.
Or it's hard, it's per deal kind of thing?
Per deal. And it's, some of it's a market. I don't want to say a marketing ploy, but some of it is how fat can I make the vacancy and still leave enough meat on the bone for the GP, right? So like in the WINDWOOD deal, there's a ton of back end. We structured it specifically with the hurdle. So there's a ton of back end meat on the bone. So the better I can perform for you, the investor, on the front end, the more I'm going to get paid on the back end because of the structure.
Yep.
So we intentionally build our deals where where we're not making a ton of money on the front end, but we make a significant chunk on the back end. And this is what we talk about often is most syndicators don't realize you don't make a lot of money as a syndicator over the life of the deal. Like the cash flow, depending on how your business is set up, like for us, our cash flow, we don't keep any of our cash flow as GPs. All of our cash flow goes to pay our employees and to keep the lights on, right? And to send us out and look at future deals and so on and so forth. Well, where we make our money is when we sell. And so we want the biggest chunk of equity on the back end. And when we get paid our big chunk of equity on the back end, we take that money and we go buy our own apartment complexes for ourselves, not in a syndication model. And that's where we get our cash flow. That's where we get our passive income. Does that make sense?
Mm-hmm.
So we live off of our acquisition fees. We use the cash flow to keep the lights on and pay employees. And then we reinvest 100% of the money from disposition and buy our own assets. And that's where we get our passive income.
So you basically try to build in as high as a vacancy as you can and make the deal still work, where you're paying enough to make it be competitive and still hit the returns you need to hit to get the investors to kind of move forward.
Totally. And it's going to be different for everyone depending on your broker relationships, because we get sourced some really, really strong off-market opportunities. And if it's a really strong off-market opportunity, your competition's less. So I can bake in some fatter, if I know what the whisper is, and I know I can get close to that with some fat vacancy built in, I can do that. If I'm in a competitive, marketed situation, I don't have that luxury.
Yeah. You're not going to buy it if it's marketed. You need to work with brokers that are you're going to be their first call, basically.
Exactly. Yep.
Yeah.
Eric, how much have you seen your deal flow change over these 18 months? As far as, I think there's kind of like a thought out there for people that are just getting started. Like, once I got a couple deals, then I'll get all the deals sent to me or something, right? But you're still, you're underwriting 60 to 100 a month. So clearly you're not just getting sent good deal after good deal. But what has changed, if anything?
Yeah, so I think we went from getting sent garbage to getting sent decent, as we proved ourselves, getting sent decent, better product, but small. And then as we have built our brand and proven our ability to close, now we're getting sent better off-market properties that are larger. And so now we're starting to compete. It's exciting for us because we went from, a couple $1 million deals to $4 million deals to $7 million deals. And we just submitted an LOI on a $27 million deal. So now and that was an off-market deal. And so now we're playing in a whole different realm, all within a 12-month time span. And so it's not about the deal flow as much as I still underwrite every single deal that comes across my desk. Now I've gotten really good at how long that takes me to determine how deep I need to go. But now we've just launched, that cash flow concierge program, which is kind of a multifamily consulting service for high net worth individuals. And that's refocusing our efforts down to smaller deals again. So now we have guys that want to buy their own product, but don't know how to source it. They don't want to syndicate it. They want to own it outright. So now we're starting to look at these 15, 20, 30, 40 unit deals again that we were kind of poo-pooing after we get to a certain size. And now we're sourcing those deals for some of our high net worth individuals to help them buy their own assets. So it's funny how it's kind of come full circle. And
are you just making a fee off that, or how are you structuring that?
Yeah. So we do everything. It's a turnkey service. So we source the deal, underwrite the deal, do the due diligence, put all the third parties into place, do everything turnkey. And we take a 2 to 3% finder's fee on the purchase price. So we have 3 of those deals under contract currently. We close our first one next week. We rolled that.
And then they take it over from there, kind of thing.
So they can either take it over from there independently and asset manage it on their own, or we'll stay on in an asset management capacity.
Eric, hi there. Question.
And yeah, what's up, friend?
Hey, how are you?
Good to see you.
Great content as always. Thank you. That what you just talked about, I heard you say for high net worth individuals. Would that work for people, looking to syndicate smaller deals? Like those numbers work in that way, or not necessarily?
No, because they don't. If it works in a syndication format, we would do it.
Got it.
The reason that it doesn't work, or we would buy it ourselves. What we do is we take basically every single deal I underwrite, because we have guys, like I've got a guy in Malaysia that has $10 million liquidity to invest in the Southeast. So we can do bigger deals. So basically what I do is I underwrite the deal, and then I just change the equity split from an 80-20 or a 70-30 to 100-0, take out the asset management fee and see what it looks like. Oftentimes, those deals don't have great overall returns because people are looking at holding it in perpetuity. So if you're using the SDA, it only goes up to a 10-year hold. So a lot of times the IRR won't be great because it's forcing you to sell in year 10. But like this deal that we're closing for this gentleman, one of our high net worth guys next week, it's a 40 unit. And he's going to see over that 10-year hold, he's going to see almost a 14% cash on cash, average annual cash on cash over that 10-year hold. And so he's elated.
And that's with self-management or a PM in place?
No, that's with our PM.
Okay. Another quick follow-up question. Regarding, like, we just closed on a smaller deal, and it's so true. Oh my gosh, feels like so much work. And it's like, we need to get a bigger deal next time. And, you know, when I kind of think of that, you know, at like, what is that breaking point numbers wise that you have seen where the PM just gets next level, more professional, allows you to be more hands off? Like, do you have a number in mind that you think of?
Yeah, it's cliche, unfortunately, but that 100 unit mark. So like we have two assets, WINDWOOD being one of them, that are in the 80s, and it presents a challenge because it's not really big enough to have full-time on-site property management. So like we have a leasing agent that's there 3 days a week. We have a full-time maintenance guy, but you're paying, when you get to the level that you have to have payroll, you're paying a management fee plus that payroll. And that's expensive. And you need a budget when you start getting into payroll. You need a budget about $1,000 to $1,100 a door, depending on your market, for payroll on top of a management fee. And when you're dealing with smaller assets or assets in tertiary markets that aren't commanding the same levels of rent as a primary market, you spend a lot more on payroll than you'd like to. And so really coming up with kind of creative solutions on how to reduce other costs has proven to be really beneficial for us. But that 100 unit mark really does hold true. And then the bigger it gets. So here's something else to keep in mind. Property management companies are traditionally going to charge you a higher percentage management fee while they're doing your value add. So like a lot of people talk about a 3 or you'll see in an OM, 3.5% management fee on top of payroll. That's not true. It is once it's stabilized, but you're not going to find a property management company that's going to charge you a 3% management fee when they're doing a ton of heavy lift in your first 2.5 to 3 years. That they're going to charge you 3.5 to 4%, if not even higher. So that's just another place where you really have to be able to sift through the OM and know what's garbage and what's not.
Eric, what's your cadence on like this one, for example, WINDWOOD, now that you're this far into the deal? I'm assuming as director of acquisitions, you're not really spending a ton of time on this one, although I do know that you're involved in everything. But what does it look like from Four Oaks standpoint on an asset management on this one? Is it a weekly call every other week?
Yeah, so we have Todd Butler is our director of asset management. Todd has weekly calls with SDMC, and they will continue weekly until we get to a point that we feel comfortable not having weekly calls. I'm still very heavily involved because I created the budget and I created the business plan. So I'm still in the monthly meetings with the owner of the property management company. And like I'm going down. The other thing that helps is we have a ton of properties in close proximity. So like we're going to do due diligence on that 28 unit I was telling you about Thursday. So we're going to Clemson Wednesday to meet the roofer and the landscaper and the sign guy. I'm in town, so I'll go do that. But I know these numbers better than anyone. So I work very, very closely with Todd on business execution. But he's running the day-to-day with the property management company.
So does he have a weekly call with Southern Development that is about all the properties that they're managing?
Correct.
For you? Yeah.
Yep. So he has a call on Monday about 3 of the properties and a call on Tuesday about 3 of the properties. And we're already having call, like with Augusta, we're already having weekly calls with SDMC about Augusta. We don't close on that till mid-December. But we're getting our transition place. We're figuring out kind of not just a 30, 60, 90. We're figuring out first week, second week, third, like that first 30 days is imperative from a takeover standpoint.
Right.
Especially with COVID, my God, I mean, who knows, like you need to be on top of evictions and filings and delinquencies. I mean, there's so much that goes into that. That's where these Michael Blanc programs, and Michael's program is fantastic from an acquisition standpoint, but that's where all these programs, the Rod Cleaves, the Michael Blancs, the Joe Fairlesses, Jake and Geno's, do a massive disservice. Brad Sumrock, is they all tell you how to buy the deal, and then they throw you to the wolves. Asset management is as important or more important than acquisition. And no one knows how to do it because no one tells you how to do it. And so all of a sudden you take over and you're super excited. And, you know, it's the old Mike Tyson adage of everyone has a plan to get punched in the face. And that happens. And it's not fun. So, you know, asset management, acquisition is great, and you can't asset management until you own a property. But there's just not enough out there in the marketplace on asset management, unfortunately.
Yeah, it's funny. It's so easy to find a playbook to underwrite a deal, but not like these things about weekly calls and the cadence with the property manager and KPIs that you're talking about. It's a little harder to learn about that stuff.
Totally. And I'll tell you some of our mistakes right out of the gate, especially early on, is being undercapitalized. Being undercapitalized is the kiss of death. And everyone, when they're new, wants to make a deal work. They want to get that first deal done so badly that they're looking everywhere that they can slice a piece of the pie off and get rid of it to force the deal to work. You're going to crowbar it into this mold that you need it to fit. And it's a bad idea. You need to be overcapitalized, if anything. And that's like this WINDWOOD deal. You know, we had a $200,000 budget for those 8 down units that we ended up getting quotes for 148. Well, I can assure you, none of our, JB will tell you, I guarantee you he's not losing sleep at night knowing we have an extra $50,000 of cash sitting in the bank.
Yeah. All right.
Questions?
Anything else?
No such thing as a stupid question, guys. I'll answer anything.
Can I ask a quick question?
Yeah, absolutely.
Hey, thanks for the presentation. It's awesome. You mentioned you are getting 60 to 100 deals, I guess you said a month. How many markets are you looking in to be able to get that much deal flow?
Yeah, so we're currently, it's not always about what market you look in. Once you get into the bigger, once you step into the next level and you're starting to look at bigger assets, it's not as much about the market you're looking at. Once you build a reputation, people are going to start sending you deals, whether you want them or not. And if they're an off-market deal and a strong market, like that Memphis deal, Memphis is not a market that we were actively looking at. We're fortunate enough to have some really good friends and colleagues that are in Memphis. So when we got sent this deal, it was just to pick up a phone call and ask about the sub-market, to know like what, like kind of some of the high-level metrics. But we're looking primarily in about 8 markets, but we get sent deals all throughout the Southeast. And so we're expanding rapidly. What's interesting to Justin or Steve's question earlier about how the quality of the product changes is when we started off, we were getting sent, 30 or 40 deals a month, but they were 15, 20, 40 unit deals. And half of them were in MSAs that were like in the middle of nowhere, And so they would send you something. They're like, and part of that was our fault because we were reaching out to these brokers early on and saying, hey, we're looking for things that are 7 and 8 caps. And the reality is it's just not a 7 or 8 cap market anymore. And the other thing is that a lot of new folks don't fully recognize is cap rated acquisition is completely irrelevant. This WINDWOOD deal, even though we bought it at $30,000 a door, it was like a 4 cap. But cap rated acquisition is completely irrelevant because unless you're buying it for a stabilized cash flowing asset with very little value add, you're not buying it for how it's performing today. You're buying it for the potential. And in today's market, you're paying for future value, whether you want to or not.
Yeah, no, that's good. Yeah, the cap rates are tough. I feel like it's a negotiating tool, but at the same time, really, you're just trying to play for investors' returns. I don't know.
The cap rate, and so it's funny because we do a lot of webinars for our investors, and people ask every single investor webinar, what's the cap rate at purchase? What's the cap rate at purchase? And when you say it's a 3 cap at purchase, you see their eyes look like a deer in headlight. And you're like, it doesn't matter. It's all cap rate is such a nonsensical, like you have to know cap rates, and you have to know cap rates at acquisition so you can add on the appropriate amount of back end basis points to know what your exit cap is going to be. That's really the only place cap rate matters, is to know where you're going to exit.
Or
Cap
what
rate at acquisition is
the
completely
sub-market cap rate is currently for that
Correct.
type of asset in that sub-market at the present time,
Yep,
not for that particular property.
correct.
And then what if I have time, just one more quick question, because I'm interested in the master lease thought that you had to start with. And what margins were you looking for? And did you offer to master lease just because you knew the price kind of at where he was selling it was good no matter when you got it, and you're just kind of holding it and helping him out until he was ready to sell? How did that, master lease, what were the margins you look for? How did that work?
Yeah, so he wasn't ready to sell. So he wanted to hold on to the property until he found his 1031 property so that he had plenty of time. And I knew that I knew the price point that he was willing to let it go for, the range. I knew that it would be a steal. And so knowing that, I was terrified that if the longer it took to get it under contract, the more likely we were for the price to either go up exponentially, or for him just to either decide not to sell it to someone else, whatever. So it was all about getting it under contract. And this was the path of least resistance that worked well for both of us. It allowed him to continue to generate cash flow, because that's how we determined what the margins were. That's how we determined how much we were going to pay him. We basically said, let's take your NOI from a T12, right? Because he was going to continue to pay his debt service. And our master lease will be your average T12 NOI, right? Logically. So he's going to make the exact same amount of money with no risk. It was nothing but upside to him. So it worked out really well for him, and it allowed us to lock the property in today at future, again, like we talked about, properties are just going up. So if I can lock in something today at today's value, for knowing I have 18 months for it to appreciate, it was a huge win for us. Does that make sense, Stuart?
Yeah, look for the master lease rates off the NOI of the T12. Makes sense.
Yep. And then as far as margins, the margins don't change for the investor at all, because the master lease payment is going to be the exact same as your debt service payment. So you're still looking for the same metrics from an investor standpoint. It's essentially a creative owner financing structure,
Okay.
So he was carrying a note essentially for us that was an interest only note, for lack of a better phrase.
Yeah. Thank you.
Yep.
Yeah, I have an asset management question. You mentioned your full-time maintenance guys. Do you source those on your own, or do you rely on your property management to source those?
So we rely on our property management company to source them, but we interview them.
Okay.
So they interview them, we interview them. Oftentimes, when we do due diligence, like this 167 unit in Augusta that Justin and Steve we're partnering with those guys on, we really, really like the current maintenance staff. And so I'm actually driving to Augusta. I'll be there on Friday to interview those guys and keep them on.
Nice.
But maintenance guys are worth their weight in gold. I mean, having the right maintenance people and having the right management company. That's another thing. We fired 2 different management companies in the first 6 months at other assets. First six months of ownership. You have to be careful with property management that you find the right company that's not a bunch of yes men. And the first company that we fired, we loved during the interview process because they were telling us everything we wanted to hear, and we were fired up. And then we got into actual, meat and potatoes of the day to day. And everything we said, nothing they generated was original content. They were waiting for us to generate solutions and then telling us how smart we were.
Right.
That's the wrong if I'm the smartest guy in the room, I'm in the wrong room.
The property management companies that you let go, I mean, what was the final straw? Or was it just dropping, delinquencies were up and vacancy was not in a good spot? Or
yeah. So one of the property management companies was I'm trying to be diplomatic here. They did things in a way that, like, they did not believe in in-person showings. They prided themselves in being tech savvy. So they would do like, oh, show yourself around, and like people can go. You need, especially depending on the property, sometimes you need a salesman on site. So because what one person may perceive as quirky, someone else can sell as charming.
Right.
So like this particular building was a 1930s vintage, had a ton of historic charm, but if you didn't have someone there to point out all the little character pieces that made it charming, people would look at that and be like, why would they do that? That's really weird. Why is it laid out this way? Why is, what's that window over the door for? One of the hallways still has the original cabinets that they used to put the milk in. Like the milkman used to come, and that's cool. And a lot of people like that. But if you just see a weird cabinet in the floor, people are like, why is there a cabinet in the floor? Like, why haven't they fixed that? Like, people don't know what they don't know. And so I'll give you a great example. We went from 96% occupied when we took the property over. Now, granted, we've raised rents $120 on average in that specific unit over the last 12 months, which is huge. But we went from 96% occupied down to 80% occupied, fired the property management company, and we're back up to 96% occupied, all in the course of a year. And we're achieving the rent premiums.
How does the transition look from property management to be getting the in with the new out the old?
So much easier to do it right the first time. Yeah. But it's a challenge. It's a challenge twofold. One, because especially depending on how quickly you let them go, you take this property over, you bring in new property management right out of the get-go, that's your people. So the tenants are getting used to that. They're getting used to all these changes. And then if the property management company's not doing a good job, then you have disgruntled tenants, and you turn around and fire them and bring another new company in to change things again. So it's hard on your tenant base, and I certainly don't encourage it. I can tell you both times that we fired our property management companies, our biggest regret was that we didn't do it sooner. We gave them too many chances to make it right, and we should have stuck with our gut and made the switch sooner.
So you're not signing any long-term contracts with these guys, obviously, then?
We did. Both times the company agreed that it wasn't the right fit.
Okay.
Because towards the end of it, we were micromanaging the shit out of those guys. I mean, we were making their life miserable intentionally, because we're like, listen, if you're not going to do your job well, we're going to do your job for you, but you're going to be. We were sending pages of reports and making them fill them out daily. So they were ready for us to part ways with them as much as we were ready to part ways with them.
Sure.
All right. Thank you, Eric. I appreciate it, man. This has been super generous of you to stay on this long and
absolutely
talk with us about this. I know we could all probably do it for another 20 minutes, but we have families too. I know I'm already in the doghouse. So thanks everybody for joining. I appreciate it. Reach out to Eric if you have more questions. I'm sure he'd chat with you and tell you a little bit more about Four Oaks. And we are going to have another one of these the first week of January. So we'll be on the lookout for that. If you liked it, we'll dive in deep on another deal and get some networking in on that one as well. So Eric, again, man, I appreciate it. Thanks for doing this. This was awesome.
Hey, my pleasure. Thanks for having me, guys.
Thank you all.
Thanks,
Appreciate you
everybody.
guys.
Yeah.
I appreciate it.